topic of our discussion today, investment ideas for the new economy. And it's my distinct pleasure to be joined by a colleague and friend, Raj Lala, CEO at Evolve ETFs. Raj, thank you for joining me today.
Thanks for having me, Eric.
Pleasure. And we know you and the team specialize in bringing a lot of innovative ETF products to the market. You've been all over the headlines over the last couple of years. Why don't we kick things off? It's been a big year for you and the team. Your 3-year anniversary and cracking $1 billion in assets. Why don't you give us a short overview of the business, pathway, where you're headed, what you're working on?
Yeah, as you said, we've been at it now for 3 years. We're almost 1.1 billion today in assets. And when we were starting this business, we took a look at the landscape. We started working on it 4 years ago. We started taking a look at the landscape to identify where there was opportunities in the marketplace. And we're big believers in two primary areas. One is we think that active management in ETFs, good active management, can make a big positive difference on a risk-adjusted return basis, especially in areas like fixed income. So we identified specific asset classes that we wanted to target, and then what we would do is we would go out there and identify the kind of best-in-class, best-of-breed portfolio managers to partner up with. So we launched a global bond ETF that's actively managed by Allianz Global Investors, who are the sister company to PIMCO, and they're owned by Allianz SE, which is the world's largest insurance company. And then we partnered up with a pretty large local manager named Dividend Capital. They're based here, of course, in Canada. They run about 30 billion and primarily institutional. They're running a lot of money for some of the major municipalities across Canada, and they're running 2 funds for us: an active preferred share fund, and as well as a active Core Plus Canadian Core Plus fixed income fund. And then on the other side of our business, which is where we've gotten a lot of media attention, is really where we've come up with specifically differentiated products. We think that there are elements of growth that are missing from a lot of client and advisors, clients' portfolios. And so part of that is we identified certain themes that we think have a really solid long-term investment thesis, and wanted to make sure that they wouldn't be considered fads. So as we kind of go through that process, we identified certain sectors and we brought products out that cater to that sector. So we launched Canada's first and only Cybersecurity ETF, Canada's first and only eGaming ETF, Canada's first innovation ETF, and also Canada's first and only automotive innovation or future of the automobile ETF. And what's been great is that since we launched those funds, all 4 of them, which you could call equity growth strategies, or you could call them disruptive technology, or you could also call them thematic strategies, all 4 of them have actually generated top decile performance since they were launched. So in the case of eGaming, we launched it just over a year ago, top decile. In the case of the other funds, cyber being the oldest of our thematics, which just crossed over 3 years, is actually first percentile in performance of all ETFs in Canada since we launched it 3 years ago. So we've had great performance, and that's why we've started to get onto a lot of investors' radars and a lot of advisors' radars because of the differentiated solutions that we've been able to bring. So it's gotten a lot more attention, which has obviously led to some pretty good growth this year in AUM.
I love it. Well, you hit a few really important things there. I think strategic choice in partners, finding best in class, bringing them all together around a hyper-focused distribution platform. I know you and the team have incredible hustle on the street with advisors and really helping them find pockets of the book that you've got product that can help them, and a lot of firsts. It helps make folks aware. I see your brand everywhere, so I obviously love the work you're doing. And you get some traditional product mixed in with some really interesting alternative themes that you can bring out and start to talk about with clients. maybe, good to share a bit of an overview on the industry as a whole as well. You mentioned a lot of really interesting things in your kind of table setting exercise. There are actually 36 managers in Canada. I think there's maybe room for a couple more, but 236 billion in ETFs listed in Canada today. That's up 27% year over year, and now north of 800 individual funds. You highlight a lot of things that kind of help you and the team stand out when chatting with clients, whether they're retail investors, financial advisors, or working with institutional money. And obviously, you put yourself forward as a leader in the thematic ETF sector. Where do you see the street kind of reacting on your thematic lineup today? Where's your focus?
It's a great question. I mean, and you brought it up. I mean, the industry's crowded. There's no doubt about it. I mean, we have more products than we potentially need in Canada, especially when you look at things from a ratio to the U.S. As many of you know, the U.S. ETF market's almost 20 times larger than the Canadian size. But you might know the number, Eric. But I'm pretty sure there's not 20 times more ETFs there. It's probably something like 5 or 6 times more in terms of number of ETFs. So we definitely have a lot of product here. I think that the biggest criticism I would have of the ETF industry here in Canada is that there's way too much commoditized products. We don't need 100, Canadian large cap equity ETFs as one example. And so for us, as we identify, the opportunity, that's the reason why we have focused in on a lot more differentiated products. Now, differentiation is great, and it's been important for us. But the challenge with differentiation also is education. When you bring a new concept to an investment advisor and talk to them about, let's use cybersecurity as an example, it's typically not a sector or subsector that an advisor knows a ton about. They may know a little bit because they hear about different breaches on a daily basis and may have looked at a couple of cybersecurity stocks in the past, but there's not a ton of depth. And so when you're bringing that to an advisor, it requires a sector education. That's one element. And then the next part of it is, for an advisor trying to figure out how to fit a cybersecurity fund into their portfolio. And a lot of advisors just don't get to that stage where they come to the resolution or realization that they are going to put a cybersecurity ETF into their portfolio. So, because it's work for them as well. I mean, it's a lot of work for them to stay on top of the sector and the product and so on and so forth. So unfortunately, the challenge, I would say, of thematic ETFs is that they can be narrow in scope. Mm-hmm. And therefore that results in advisors not necessarily integrating them into the portfolio. However, it's changing. We're definitely starting to see positive momentum. There's a lot of reports that have been coming out in the last 6 months. I would say the McKinsey report is probably the best that I've seen, which basically says that over the next 10 years, we're going to have $90 trillion that's going to be added to our equity market capitalization. Okay.
Wow.
Half of that 90 trillion is going to come from disruptive technology. So if you continue to ignore disruptive technology and not integrate it into your practice, then you're potentially going to be missing about 50% of the growth that we're going to have in our markets. And the likelihood that companies like Apple and Amazon and Netflix and Google have another double or triple in their stock price from here is pretty low likelihood. So, what you ultimately want to do when you're looking at disruptive technology is you want to be able to find the Apples from 10 years ago and the Googles from 10 years ago and invest in those types of companies to provide you with that growth. So we're starting to see more and more advisor positive views towards some of these sectors. And I think that that's really important because ultimately that will lead to more and more investments. Because the truth is, Canadian investors have very little exposure to disruptive technology. If you believe that 50% of the growth is going to come from that over the next 10 years, then the fact that most Canadians only have 5% or less invested in disruptive technology means that it's actually very underrepresented in their portfolios.
When you're looking at, high growth organizations and finding that next Apple, I'm assuming that's a East North American discussion for you, but what's an example of somebody that you're looking at now or might have made their way onto your screeners for your ETFs today? Like what kind of companies catching your interest?
Yeah, disruptive technology companies, it's a broad term, right? But I would say that, some of the biggest disruptive factors that we're going to have over the course of the next 10 years would be things like cloud computing, would be genomics, would be robotics, artificial intelligence, even going narrower into things like 3D printing. Those are areas, and probably one of the biggest ones that I should mention is probably the car. That is going to be a massive disruption. And from a technology perspective, I mean, we are moving towards an environment where your car is probably going to be, if it's not already, the most sophisticated piece of equipment that you have. Not to mention that it's probably the second biggest purchase that you typically would make next to your home. So that's going to, and you're starting to see the elements of autonomous moving into cars today, getting more prevalent. So to me, the future of the automobile is a big disruptive factor. So those are some of the types of companies, and then you can filter down into companies specifically in those subsectors. But those are subsectors that I believe over the course of the next 10 years are going to continue to become more and more relevant, and that's why investors should be looking at some of those types of companies or ETFs, of course, that are focused around those themes within their portfolios.
I like it. Thank you for the color. It certainly gives our audience a bit of a view, I think, on how they should be thinking about their portfolio moving forward, and obviously a lens on where your focus is as a firm on the thematic side of the business. Maybe flipping gears into the core side. We're in unprecedented market times, of course, and looking after kind of the growth side of your portfolio is definitely important, but also protecting what you have becoming an interesting topic of discussion now, especially in the volatile markets that we've seen over the last 6 months. You've got some product on the fixed income side of the business you mentioned up front with some large partners, Addenda and Allianz. Where are you seeing the conversation trending to now, especially as we're headed into an election in the U.S.? What are the kinds of things advisors are starting to put back into your court and say, hey, what do you have that can kind of cover off the next month or 3 months? What are folks asking you about?
Yeah, the market continues to defy gravity, right? I think 99.9% of the people out there would not have expected this kind of rebound when COVID started to kick in March, but we've had it, and it's been great for those that have been invested. There's still a lot of people that are sitting on the sidelines waiting for the time to come back in. But I think you cannot deny that we are going to enter, if we haven't already entered, into a recessionary environment. And that doesn't necessarily mean that the markets are going to be terrible, but you can definitely see that the economy is going to struggle over the course of the next couple of years, given all of the printing of money and everything else that's gone in to the economy in terms of bailing us all out. So traditionally, you look at sectors like gold and even healthcare to be recession resilient, which they are very much recession resilient. But again, going back to that disruptive technology conversation, you're seeing an emergence of other sectors kicking in, showing strong elements of recession resilience that are off the beaten track. Cybersecurity, another great example, right? I mean, when you think about it, cybersecurity is there to protect our data. Data is our most precious resource that we have today. It is the most precious resource for every company and every government agency worldwide. If we enter into a recessionary environment, it's not as though companies are going to reduce their spending on cybersecurity. They still need that hardware, that software, that consulting service as well. So cybersecurity has some really strong tendencies of recession resilience, which is not something that you would typically think about, right? when you're thinking about where am I going to invest in for a recession or during a recession. Cybersecurity is probably not the first one that comes to mind. The other one that may actually come to mind a little more for some people is eGaming. If we're in a recession environment, eGaming could continue to do well because it is one of the lowest cost forms of entertainment that exists out there. So maybe instead of, hopefully at some point you can start going out for dinners again, but if we're in a recession, maybe instead of going for dinner or going to a show, because you don't have the disposable income for it, you stay home and you game. And it was interesting to see in March that when COVID really kicked in and the markets really struggled and became very volatile for that month, the performance of some of those funds within the ETF universe. So give you an example. There's call it 800 equity ETFs in 800 ETFs in total, but there's about 550 equity ETFs in Canada, and only 5 in March had positive performance. Only 5. We had 3 of the 5. So our healthcare fund ended up being the top performing fund period for the month. Our eGaming fund and our cybersecurity funds all had positive performance in the month of March, all displaying these tendencies of recession resilience. And it makes a ton of sense, right? I mean, healthcare, of course, healthcare is front and center during this pandemic, but also in general, healthcare is a very strong performer in a recessionary environment. Everybody got vaulted into a work from home environment, right? Yep. So companies weren't prepared with their cybersecurity infrastructure. And so companies needed to beef up that infrastructure, and or if they had enough, they needed to make sure that all of their employees were well trained, because it's one thing to build a fence around your corporate data centrally served. It's another thing to build a fence around everybody's home, whether it be their Rogers network or their Bell network. So cybersecurity became very, very important. And also a lot of people now at home have a lot more leisure time and no sports. I'm talking about a few months ago, no sports to watch on TV, no sports that they could even compete in as well. So eGaming and eSports really started to kick in, and the subscriber base grew significantly as well. So if you think that we are in or going to be in a recessionary environment, those are the types of areas that may be worth considering.
It's an interesting one, and it is important. It highlights, need to just think a bit differently, and also, kind of wrap your head around the environment we're going to be in, which I know is certainly uncertain on a number of fronts at the moment. But knowing what you're doing, and even looking at a bit your own day to day, it can provide you some insight on what could do well in the market ahead, as we're all likely to be staring at the same four walls at home for a little while longer.
It's a good point. It's a good point, Eric. You may not be old enough to remember Peter Lynch, but Peter Lynch is a legendary portfolio manager that was part of Fidelity. He ran the Magellan Fund, and one of his thesis or his strategies was go around and see what products people are using. Go to the grocery store, see what's missing on the shelves because it's already sold out, and what people are using on a regular basis, and apply that to your portfolio. Because instead of just being a consumer of the product, be an investor in the company that makes that product. Because most likely, if you like a product and you see other people like it, well, then the company's probably going to do well, and it's probably worthwhile to own that stock. And that applies really well to a company, to a concept or to a fund like eGaming, because you see it around you. If you have a kid and your kid is borrowing your credit card on a regular basis, you know how much they're spending on eGaming on a monthly basis. If you have a parent that's elderly, you see them spending time on Candy Crush, for example. If you have a 40-year-old friend that wakes up in the morning on Saturdays and competes in an esport with their other friends, you know that there's consumption taking place. And when you see articles like, Reed Hastings, who runs Netflix, when Disney Plus came out, he was interviewed and people asked him, like, are you concerned about Disney Plus coming out? He said, actually, I'm more concerned about Fortnite. because Fortnite is a much bigger potential competitor to Netflix than Disney Plus is. So when you see all those kinds of things, you say, okay, there's a lot of consumption of this service, and instead of just being a consumer, be an investor.
Participate in the business you're a part of. Makes a ton of sense.
Yeah.
An interesting one, right? Are you starting to see advisors and money, and whether it's looking at your lineup or looking at the ETF industry as a whole, are you starting to see them kind of reposition into security now? Are they starting to look at thematics and how I put some money back to work? Are you starting to see people pay attention to that trend again?
Yeah, I mean, I'm talking to it's somewhat bifurcated out there. I mean, some advisors are definitely changing things around within their portfolio and looking at some of these areas to invest in. We're definitely seeing like our eGaming ETF. I mean, the performance has been fantastic. I think we're up like 45% this year, 50% this year. The performance has been fantastic, but for a while there, we weren't getting a lot of adoption. And part of the reason why I think we weren't getting a lot of adoption is that people don't take it seriously. They don't take e-gaming seriously. Now, and part of it is if you're my age, and I'm, unfortunately late 40s now, if you're my age and you're an advisor that maybe doesn't have a kid that games, you can't really relate to why you would want to invest in e-gaming, because you remember video games from when you were a kid and you haven't really seen how the business model for these companies has evolved. I mean, 15 years ago, if you really liked the game, you would go to the store, you'd buy the cartridge or the disc, you'd bring it back, you'd plug it into your console, and away you would go. That's where the revenue stream stops for the game producer, the production house. In today's world, these companies have so many lines of revenue that they've been able to build out. First of all, as you know, many games are free to download, but where they generate their revenue is in the boosters, and in the case of Fortnite, the skins, weapons, and so on and so forth. I mean, the average millennial right now is spending over $100 a month on gaming. Okay.
But really,
Yeah, and it's all through the in-app purchases. So there's that. And the key for a gaming company is to generate engagement, right? You want more people to actually play, but you also want viewers. If you had asked me a couple of years ago, or told me a couple of years ago that, hey, by the way, Raj, like, did you know stadiums are getting filled with people watching other people compete in an esport? I'd be like, what? Seriously? But it's true. And it's funny. I talked to a gamer once and I said, I don't understand that. I don't understand why people would go to a stadium to watch other people compete in a video game. And he said, with all due respect, Raj, I don't understand why people in your generation watch cooking shows or watch like home improvement shows or Flip This House or something like that. I'm like, that's a really fair point. Because what seems strange to us and a foreign concept to us, some of the things that we do seems really strange to them. So the viewership, I mean, right now the viewership directed towards e-gaming is it's like 11% of all YouTube viewership hours is about gaming. It's not just about watching people compete. It's also about like watching videos on how to get better at your own gaming experience. So think about it. If you have all those eyeballs playing the game, if you have all those eyeballs watching other people compete in a game, if you have these stadiums filled, then think about all the different revenue streams that these companies can generate, because now they can generate sponsorship revenue because teams are going to want to get sponsored by big branded companies. Now you're going to have companies knowing that there's millions of eyeballs on the game, they're going to want their logo out there. So you've got companies like Red Bull, you've got T-Mobile, you've got Adidas, and so on. That's all kind of trying to get their brands or their logos positioned within the game as well. So if you're a gaming company today, you've got recurring revenue through all the in-app purchases, you've got sponsorship revenue, you've got event revenue potentially, you've got media rights, because now people are watching it on TSN, right? Watching other people, ESPN, watching other people compete in the game. So when you look at that from a business model perspective, you're like, okay, this makes a ton of sense as to why you would want to invest in companies like that. And now they're getting even better, which is a number of them are trying to move towards monthly subscription models.
Yeah. Like Netflix
pay,
or Apple TV. Yeah.
which is brilliant, right? You pay $10 a month and you get access to our full catalog of games. And just one more thing on gaming, because it's such a great, fascinating area. It's a real business. It's bigger than the entire film and music industry combined. And soon it's going to rival television, where if you add in TV, film, music, it's going to be about the same size as the entire e-gaming industry. Yet
that is fascinating.
most people don't have any exposure to the space. And it's not just here in North America. I mean, it's an Asian phenomenon as well. So to me, this is a really interesting area because of the growth from a media perspective, and also some tendencies of recession resilience. And what's also, one last point, and then we can move off gaming, because I think it's really interesting. You know how we're seeing the news about how Disney is delaying releases of movies, and some of the other movie production houses are delaying releases partly because of COVID. Well, guess what? Gaming companies don't need to delay any releases. They don't need to hire actors to congregate and be in a part of a movie. So this can all be created. And and think about gaming in a different way. If you watch a movie, it's unlikely you're going to watch the movie again, unless you really love it. Like I think you love Godfather, right, Eric? So you probably see The Godfather like 20 times or something like that. But most times you'll just watch a movie one time. If you play a game, you're not playing the game one time. You're playing it 5, 10, 20, 1,000 times. So it's great from that perspective that it actually never becomes a really stale experience. So the catalog doesn't become obsolete.
I'd put Iron Man into that kind of background movie. For me, I could watch that over and over again. But the scary part about video gaming too, and I play a little bit from time to time just to burn up some time. But the scary part is they're actually keeping track of how many hours you're burning in front of that screen in the first place. And that's the, it's like Instagram or Facebook, where they used to tell you, okay, you got this much screen time in front of you now. You're now very much aware of how much time you're spending in front of the screen.
It is, and and that's a bit of a stigma too, right? That it's a complete waste of time. However, I would also throw this point back out. During COVID, it was one of the few ways for people to socialize. They couldn't go and see people. People got tired of Zoom and some of the other video apps. A lot of the kids, where we were all concerned about their mental health, a lot of the kids, this was their outlet to communicate with their friends, and it became actually a social media service for them to actually use. So there was actually some pretty good benefits from this during the pandemic.
That makes sense. I mean, you even saw Joss, our CEO, get onto Fortnite for one of our corporate clients earlier.
Yes.
Anything could happen, and this environment kind of creates the right ecosystem for it. So it's sitting in his big chair with sunglasses on. I don't think he could have paid me to see that. So.
Well, you see, like David Beckham is now getting involved with eSports with company Guild. Like, I mean, you're seeing a lot of big celebrities getting more and more involved. A lot of the athletes that couldn't play their sport, 6 months ago, started getting involved in eSports as well. I mean, it's a real business. And sorry, going back to one of your points, the biggest challenge I would say with that product is that a lot of advisors just haven't taken it seriously enough, because they think it's games, toys, like, fun. It's not investing. But when you drill down into these companies and how well they're doing and the revenue lines that they've built, you can start to appreciate the investment opportunity.
Look at a company like DraftKings, right?
Sure.
The US, and actually the part that kind of ties that one all together. Like from our perspective here at Neo, we're paying close attention to a number of these companies because they're all starting to look at faster ways of look through some really innovative pathways that, as you've been highlighting with the thematic ETFs and the different way of thinking, going public in the traditional way through an IPO. They're finding their way to market through these blank check companies or SPACs and pushing hard to go public in the middle of this pandemic because they're having a great year from a business perspective and they need the influx of cash to keep moving. I think already this year in the US, I think this week already they priced 13 SPACs, a couple $1 billion coming out. Like it's an unreal market in terms of how it's developed. Canada hasn't really caught up yet. I know you guys pay close attention to a few of those trends, but it's just fascinating to watch.
There's a SPAC ETF now, right? That listed last week.
There is. Yeah. That's a great point. There's a few, and there's one in the US too. I think Defiance now has SPAC ETF.
That's the ETF I'm talking about.
Yeah. So it's neat to see how that the market's creating product. And you made a comment at the beginning too. We do have a number of ETFs, obviously listed in Canada. Some overlap for sure, and a lot of competition in the core space. There is still a lot of different ways to slice up both the Canadian, North American investment universe. To your point, you find clients that want to work with you. You have a solution. You want to keep them under the Evolve umbrella. You're going to keep innovating, keep disrupting. You're going to be the same way.
How many more quality dividend strategies do we need?
It's an interesting question, and maybe one also. How many of those organizations will maintain that dividend in the quarters ahead? It'll be a different journey.
For sure.
It's funny, Raj, something just occurred to me as well, and I didn't really realize it until now, but Neo is actually the home of all of your fixed income, or almost all of your fixed income and kind of recession type managers.
Yeah.
We've got some of your larger ones too with us.
You are the home for a lot of our recession resilience. It's true. I mean, we didn't talk about our cash alternative product, HISA. But that is our largest product in terms of our assets, and there's a lot of money on the sidelines. You may have some of it getting deployed, but some of it probably coming back as well. But it's tough to find a good rate on your money, right? Compared to 6 months ago, when you look at GICs paying out 15, 20, 30 basis points for 1 year. I mean, it's almost better to put your money in your mattress. We launched that product, HISA, about a year ago. We're coming up to a year. It'll be next month, I believe. It'll be a year, and it deposits with 4 of the big 6 banks and earns the overnight rate plus 50 basis points. So the yield on this is 75 basis points, which still doesn't sound great, but on a relative basis, better than other money market funds that exist out there, better than other GIC rates that you can get out there. So yeah, I mean, it doesn't get more recession resilient than cash, than holding cash, right? So cash is definitely one of them. And we just launched a new fund with you guys, our gold miners fund, GLC, and obviously gold is a great place to be investing during a recession, and gold miners are a nice levered play on the price of gold as well.
I like it. And the cash one, it's a neat one because I don't know that there's all of the education on the street perhaps that there should be. That I still find the occasional investor or advisor from time to time that's got money sitting in their bank account, not in ETF. I mean, it is a liquid vehicle. It doesn't have a 1-year renewal period where
that's right.
You're going to keep your money and you've got to remember to cancel it back. The ETF kind of solves a number of, let's say, traditional issues with the GIC product and gives them the flexibility to come in, come out, and it's not small. You guys are working with, as you said, bank depositories. You've got big money you can move around on a daily, intraday basis if needed.
Daily liquidity, no penalties. To move out. So it's been a great product for a lot of people, and a lot of advisors and investors have been using it pretty regularly.
I love it. Well, obviously, thank you for the support on that front. I know you're a fan of competition in this ecosystem. Doing obviously to disrupt yourself. Hopefully, I'm not
I'm a
putting words in your
fan
mouth.
of competition. I'm a fan of great service, and I got to say, working with you guys at Neo, the service is impeccable. Yeah, the entire team there is just fantastic. And it starts at the top, right? And yeah, great. It's a pleasure to be working with you guys for sure.
Oh, thank you very much, Raj. And I know that the team appreciates the comments. Even a quick email you sent through a kind one a couple of weeks back. Responds well to those. They know they're working hard to make the experience perfect for our partners, and everybody gets what they want. And ultimately, we're doing everything we can. That's the beauty of, I'd say, being owned by long-term investors. We're making sure that we overservice our partners through the way to public markets, whether it's ETFs, closed-end funds, working with public companies and SPACs today. It's a very critical part of our business, and one that I think you can expect to continue.
Yeah, and on another note, not to flip the switch and interview you, but I wouldn't mind talking a little bit about this, because you were asking me before, what are some of the obstacles that you face with your ETFs? One of the obstacles that we definitely face is that some of our funds, they may not have a ton of trading volume on any given day. There may be a period in a couple of our funds where there's no trading volume for a couple of days, or they might trade some shares in the morning and not really trade in the afternoon. And one of the biggest challenges that we've had talking to advisors is the comment that, if I buy your product and if you have a 5% lift in the market that day, but you only traded in the morning and you missed the entire lift, it just doesn't look good on my client statements. How are you going to solve for that? And that's been an issue for us, and I would imagine that that's been an issue for every ETF company that has products, and we all have products that don't necessarily trade that regularly. So I think for this audience who's here, I think it's worthwhile for you to talk about the initiative that you guys are undertaking for that, because to me, I think that's really important.
Thank you. It's something that we didn't catch on to at the beginning of our business when we started launching ETFs in Canada. We did them the way they've always been done. ETFs, they fit down the equity plumbing. You have a ticker, you have a symbol, you hit buy, and you go. What we realized over time, and as an exchange, we pay attention to North American markets, global markets, frankly, and how they're changing, and making sure that we stay competitive with our business. We saw a trend emerging out of the U.S. Actually, an old friend of yours, when you were formerly Wisdom Tree, put us on to an idea in the U.S. that they were starting to look at how they could solve some of these frictional issues and really adopt what is our exchange plumbing to fit the ETF vehicle, as opposed to just making ETFs look like traditional stocks. And we had a few good conversations with folks like yourself, ETF managers. We had some chats with advisors, dealer back offices, market makers, what I'd say is a proper industry consult. And this issue is one that you're right, it's happening across the board, across businesses, across ETFs. It's most prevalent in new ETFs. And it's actually more prevalent with ETFs that trade across multiple marketplaces in Canada, because the conventional rule is your portfolio will only update on last trade, or closing price update on last trade on the listing market. Mm-hmm. So having fragmentation in Canada, there are actually 12 markets that trade ETFs today. Neo's about 20% market share in that volume. Our volume doesn't count towards setting a closing price in your listing exchange. Same with NASDAQ, or you might see Omega or a few other markets on your screen. So there's one big nuance there. For us, our Neo listed securities, your gold, your cash, your fixed income ETFs, we consolidate marketplace activity. So every trade in an ETF counts. It's a valid price. It should be pushed through. And the second thing that we've done, which I think addresses a comment that you made in the onset, if an ETF doesn't trade, it is not like a stock. A trade is the only indicator of the valuation of a fund. Your underlying securities, your eGaming securities, North American markets, fixed income, whatever, they may have adjusted their price through the day. And it's important, like a mutual fund, to benchmark the price of that security as you're heading into the close. So we've come up with a novel way to do it. It aligns ourselves quite nicely with the big US exchanges. We'll be the first ones in Canada to implement it, where we will actually take a time-weighted midpoint price in the last 15 minutes of the quote, and we will send that out as an ETF close if there is no trading at the end of the day to push through in the dealer back offices and Bloomberg screens and Thomson Reuters and public websites. So we're trying to make the price more accurate, make it transparent. I think this is a needed change for the ETF industry as a whole, and we have, as you rightly pointed out, a comment process with the regulators right now until October the 24th. I'd encourage the audience. I know Raj, I'm sure we can count on your support. It's something that doesn't just impact managers. It impacts portfolio managers who are running institutional money. It impacts advisors. It impacts investors, and it's an open and public comment process. Put in a few words. We support evolution, change, and competition in Canada. This is critical. So I really appreciate you bringing it up. You certainly didn't have to, but it is something that, as a market, we pay very close attention to, and I think there's more work to be done. I'm not saying this is everything solved, but we've got to start.
Yeah, you guys champion a number of issues. This is definitely one that I think is really important. Not to say that the other ones weren't, but this one is really important, and selfishly, it impacts our business as well. So thank you very much for your time today, Erik.
No, my absolute pleasure. Not to flip roles, I will. I'm just seeing the red light popping in the corner here.
Yep.
We've managed to get through 45 minutes in what feels like 5, as always. A sign of how we get along and can have an easy. Raj, obviously, really appreciate you coming on with us today, sharing some insights on the industry, what's going on around us, both with thematics as well as the fixed income and that flight to safety market. 30 seconds or less, one message you wanted to leave with the advisors on screen, anything you'd like to share?
Yeah, I think it's really important in times like this where a lot of clients need their hands held, but they also need to be forced into doing some things that may not be as comfortable as it would have been in the past, and taking a look at areas of the market specifically, and going back to disruptive technology as well, creating a really well-balanced portfolio that gives you some exposure to some disruptive technology, has some elements of recession resilience attached to it. I mean, that's, to me, the holy grail within portfolios right now, because you're not getting a lot from fixed income at the moment. So trying to figure out where to place your money within equities, I think, is becoming the big task. You've got a lot of options out there. There's tons of options out there, as you said. Over 800 ETFs in Canada. So thanks to everyone that's been using our products. And I'm glad that they've had such a positive experience with it. And keep up the good work at Neo, Erik.
Oh, brilliant, Raj. Likewise, push hard. We're in your corner. With that, folks, we're right on time. We'll get you back to your day. Raj, thank you for joining us. I assume if our audience have any questions, they can email you, email your sales team, reach out, connect, ask questions, be curious, and look forward to chatting with you again soon. Be safe.
Take care.